back, folks. This is the 6th of 8 teachings in the November 2016 curriculum of the ICT mentorship. Okay, we're going to be teaching the macroeconomic to micro-technical. Macroeconomic to the micro-technical. Macroeconomic to the micro-technical. Okay, and I'm showing you here one of the secrets to how I'm able to call the markets as I do. And it's a macro perspective. So in other words, it's not a day trading perspective. It's not something that's going to be forcing you to look at 15-minute charts, not even an hourly chart, not even a 4-hour chart. Okay, we're going to be looking at daily charts only. And you probably are wondering, why is there a top secret image here at the bottom? Well, below this cover is going to be one of the closest guarded secrets of my repertoire. And when I look at the marketplace, I use this as a barometer to help me determine where the long-term trend of the marketplace is going. Now, there's a lot of folks that will scour bank reports, and my opinion of bank reports are this. Why would a bank tell you what their intentions are? It doesn't make any sense. That's like having a football team tell you what their plays are going to be for the Super Bowl. It just doesn't happen. So when I look at the marketplace and I'm looking for a long-term macro view, I'm looking for an insight that would give me a 3 to 6 month outlook on where currencies may be heading, in what direction. And one of the things I use for that is interest rates. And the way we find interest rates, the way I do it, is I'm looking at the bond market. The 30-year Treasury market will give me the insights I need for interest rates on an intermediate to long-term basis. Long-term to me is 3 to 6 months. It may not be long-term for you, but it is for me. So what I look for is every three to 4 months, there is a quarterly shift that takes place. And what I mean by that is whatever trend or whatever market condition is prevalent for right now, in 3 to 4 months time, there's usually a shift. Okay, there's either a reversal or it's an extended period of consolidation, and then a future resumption of the trend, or again, a reversal. But every 3 to 4 months, I'm looking for a change in direction, because I believe there is a quarterly shift that takes place in the marketplace, and you'll learn a lot about that later on in this mentorship. But for now, I want to teach you how I use the bond market and how I use the interest rates as a precursor for where the markets may go. I don't require a whole lot of fundamental data to sift through. I don't believe I have enough time in the day to go through all that. I know there's a lot of folks that would probably hear me say that and scoff at the notion that fundamentals are that's the backbone to the marketplace. You need to know those things. And my submission to that is who can keep up with that? I don't have time to keep up with it. I'm busy running a life. I don't have the time to be sifting through all the information, and quite frankly, I'm not that astute to be able to discern what that data is. So what I require is a visual interpretation of that data, and what I subscribe to is the bond market will tell me that. If I can read price action in the bond market, and not just the bond market, but we're going to look at the 10-year notes as well. If we can get a feel for what the bond market's wanting to do, whether it be trade higher or lower, then we can have a pretty good basis on what the interest rate market's going to do. Okay, so what we're looking at is about June, July, August time period. Okay, June, July, August time period. The top chart here is obviously the dollar index daily chart, and the lower chart is the Treasury bond market. This is the December contract. Okay, so December contract for the dollar index above us in the futures market, and the December contract for the bond market on the lower end. Okay, so the lower chart is the bond market. Between July and August, there was a high that formed in the bond market. And for those that follow along on the Twitter and on my YouTube channel, this summer I mentioned that the debt market is going to have a major decline. and I said that that was going to happen. I also said it was going to happen in the Bund. I said it would happen across all of the debt instruments. So basically, what I was implying was that interest rates were going to go higher. If interest rates are going to go higher, that's going to allow the dollar index to go higher. Okay, but when interest rates are going higher, that means that the bond market is going to drop. As the bond market rallies, that's a lowering of interest rates, and when it drops down in the futures market for the bond market, that is an increase in interest rates. Okay, now the 30-year Treasury bond is the benchmark for what we have in the U.S. as our mortgage rate. We put a house on the market for purchase. If someone wants the ball and chain debt program to pay off a house for 30 years, the interest rate that's arrived at this market pretty much is the benchmark for it. There is another interest rate asset market that I look at, which is the 10-year. And I look at that, and we'll look at that later on in this teaching here. But what I want you to look at is when the bond market is creating a high here, okay, at the same time that the dollar index is making a low. Okay, I want you to take a look at what's going on here. In the last week of June, we have the dollar index making a low, and the market failed to make a lower low at the same time that the bond market was making a higher high. Now, in lesson 5 of this month's teaching, I taught you the SMT divergence relative to the dollar index and foreign currencies. That same idea is applied here, but for an interest rate divergence. In other words, we're looking at how the bond market interacts with the dollar index. So around every 3 to 4 months, there's going to be this shift that takes place. This underlying change in trend is seen in the dollar index with the failure to make a lower low at the same time the bond market made a higher high. Market traded softer. At the same time, all the way into the last week, midway point of August, we saw consolidation in the bond market as well. Then we saw what? The movement higher on the dollar index. At the same time, we were seeing weakness in the bond market, which means interest rates are increasing, which means now we have the dollar index pulling back into a down candle, which is a bullish order block. So we can expect to see prices move higher on the dollar, which will do what? Send the bond market lower. So when we see this rally up, it's returning back to an up candle, which is a bearish order block. Then it sells off again. This sell-off, okay, accelerates the buying in the dollar. So if the dollar is going to accelerate going higher, let's go back to this time period here, okay, and reflect on the analysis I was given in the mentorship. You all know that I was looking at this particular time period right here on the dollar, and I said that we were going to start going higher, and we're going to be looking for that $1 mark, the potentially 102 mark. And the reason why I suspected that was going to happen is, number one, I was looking at the dollar pairs that are started with the USD as in their name. In other words, like dollar CAD, dollar Swissy, dollar yen. I was looking at the dollar CAD, and it just supported the idea that we were going to go long here, or start to go higher. At the same time, the bond market was rallying up, returning back to a bearish order block. So I knew what to expect was to see if we turn the tide here and start going lower on bonds, that drop down in bonds is an increase in interest rates. An increase in interest rates is going to see a aggressive pouring in of funds to buy up the dollar. So that's what we're seeing here, that aggressive rally up. The market showed a willingness to drop even lower here on the bond market. At the same time, there was a small little decline at the same time when the bond market was dropping. Small little deviation from what would be considered the normal. That was all attributed to what? The U.S. elections. Nobody knew what to expect with the elections, except for ICT. He said Trump was going to win. So obviously Trump won. Overnight, the futures market were tanking, and the dollar index sank, and the Dow Jones futures were down like 750 points at one time overnight. And then all of a sudden, the very next morning, everything was peaches and cream, and it's been rocketing up since. In 10 days in a row, the market's been rallying up for the dollar index. At the same time, we've seen an accelerated sell-off in the bond market, which means there's an increase in interest rates. So when we look at the marketplace like this, utilizing the bond market to help us, we can use that same idea as it relates to looking at divergence between the bond market and the dollar index. So with that said, I'm not going to go into great detail because obviously you know what I mean by that by using what was taught to you in the 5th teaching of this month's content. Okay, folks, we have the 10-year note to the left and a 30-year bond to the right. Okay, I want you to take a look at the SMT divergence that we have in these two charts. Okay, and I'm going to take a look at the currency markets and see how that assisted us in analysis. Now again, this is a long-term to intermediate term concept. So it's aimed at giving you the next 3 to 6 months outlook on where currency should be going. Okay, so take a look at the 10-year note here, making a higher high here. At the same time, 30-year made a lower, bond market took off lower. So the second week of September, we saw interest rates increasing by the effects of the bond market and the 10-year note declining. Then we saw the last week of September going into October, we saw this higher high form in the 10-year, while we saw a lower high or SMT divergence in the 30-year. And then immediately we saw another decline in both 10-year and 30-year, which is an increase in interest rates. So right away we know that there should be an accelerated buy or a rally in the second week of September and the last week of September for the dollar. So let's take a look at that. Okay, we can see here the dollar index. First week of September, here's that low we would expect because we saw an increase in interest rates as a result of the sell-off with the divergence between the 10-year and the 30-year bond market. And in the last week of September, we saw the market make a rally away from that point as well. So we have a rally here and a rally here, and it begins that big movement higher. Now, if we see that in the dollar index, we should be seeing rallies in dollar Swiss. Here's September, this month here. First week of September, it rallies. Last week of September, it rallies. So we see that same effect appearing as well in that dollar pair. Let's take a look at the dollar CAD. Here's September, the first week of September, it rallies, and it's last week to this month of September, it rallies again as well. Let's take a look at the euro. This is going to be the opposite. We're going to see a high form the first week of September. There we are. And then it sells off again the last week of September. And there you go. It rolls over. The pound, we should be seeing a high form in the second week of September and a sell-off the last week of September. So a high here and a high here, an accelerated sell-off. Okay, and that was the reason why also I told you we were going to be looking for these lows to be violated. That was all behind the scenes why I was calling that move here. Okay, and which also led to our target, or my target that I shared on Twitter and on YouTube. It's still my YouTube channel videos calling for the 120 level for British pound before the Brexit. So, and we'll add one more. Let's take a look at the dollar yen. Okay, and we have a low that formed in the first week of September. In the last week of September, there's that buy, and it takes off, and it's taken off extremely high. So again, it's a macro perspective using macroeconomic principles, interest rates, okay, and then utilizing that down to a micro technical. So we can take all this information, okay, and from the month of September, start looking for a reason to be a buyer for all the dollar-based currencies that start with the dollar first in their name. We would be going long those pairs. New Zealand dollar, we should be seeing a sell-off around the first, second week of the month. We see it here. Last week of the month, we see it here. And Aussie, we should be seeing a sell-off the first week of the month here, and the last week of the month here, and you see that as well. Okay, so again, it helps you, it builds an idea about where the market should go because of the underlying fundamentals, which I don't have to go through fundamental reports to do all that. I can rely on the interest rate markets that I know, which is the bond market and the 10-year note. Couple that with the dollar index, it's like the pins in the lock turn for you, and no one can take it from you. So let's go back to the 10-year and the 30-year note. Okay, now we're going to take a look at the rally higher here on the 10-year that was not seen here on the 30-year. So we know that there's going to be an accelerated rally on the dollar index the first week of November, obviously post U.S. elections. And let's go back to our dollar index chart. Now we see November. We made that lower low. So that whole overnight fiasco with the sell-off on the dollar and the Dow Jones was all fluff. It was all manipulation, because we see that lower low here in dollar, but we did not see it in higher highs seen in the 10-year and 30-year futures on the debt instruments. So interest rates were calling the shots still, even though short-term heart attack on the charts in this down move here on the dollar and Dow Jones overnight, the day of the election, everything was put back in gear longer term with the acceleration on the up move on the dollar rally, chasing higher yields. And you can see that also in the form of dollar Swiss, dollar CAD, weakness, even though it looks like it's strength above an old high. Remember, that's that false movement we look for. SMT is telling you it looks bullish. What's the underlying tone of the marketplace? There's no way that dollar is going to allow Aussie dollar to rally, and that's why we're seeing it give up the ghost. Same thing with the New Zealand dollar. It looks bullish starting off running, just taking out an old high and then running down lower. The dollar CAD accelerated to the upside. Euro as well, that initial run up, clearing an area of buy stops we talked about during this mentorship here. Hit 113 big figure, and it's been slamming lower since. So I hope you take this information, keep it close to your vest. In other words, don't share it with the general public. Most people will never learn this tactic. I don't have a source to be able to say I learned it from this one and that one. It was just me understanding the bond market as a futures trader and understanding that the interest rate markets just basically control everything around the world. Okay, it makes everything go. In the financial industry, without interest rates, nothing moves. So if I'm going to understand the interest rate market, it just stands to reason. If as long as I know the bond market and the 10-year note, I'll know everything I need to know. And take a look at the bond, the German bond, and you'll see that it's been going down also. And that's the reason why I said it was going to go down. Everything that's been shown here today in this teaching, again, please, please don't make it common knowledge. Until next time, I wish you good luck and good trading.